Uh, we are now being recorded, so take due notice thereof and govern yourselves accordingly. I'm going to close this transcript window because apparently that's a new feature that freaked me out last time we did a call. So this call is it's the math behind retirement accounts. And I've always been kind of a big fan of doing retirement accounts. I focus on my Roth account. I'm going to get into all that stuff. But when I was doing the math on this, I kind of surprised myself a little bit. So I want to start by kind of talking in general terms about what retirement accounts are and how they work. There's two basic types of retirement accounts. It branches off into a bunch more, but I'm just going to go with the basic ones. The one that most people have heard of is a 401k. And in that kind of a retirement account, let's say I make a certain amount of money and I want to put $3,000 into my IRA account. Let's say I had made $100,000 for the year. I put 3,000 into my 401k, and I don't get taxed on the 100,000. I get taxed on 97,000. So what happens is I get the benefit of not having to pay taxes on that $3,000. It goes into the retirement account, and then when I hit my retirement age, which is a minimum of 59 and a half, according to the IRS, and I start pulling money out, I pay taxes then. So there's three real reasons why people would like that kind of a retirement account. The first one is if you're in your big earning years, it's the assumption is you're at a higher tax rate now than you will be in retirement. So if I'm at a 36% tax rate now and I put $3,000 in, it's really only costing me two, right? Because I'm not paying taxes. I get the full 3,000. I put it in, and then when I'm in retirement, let's assume I'm in a lower tax bracket. Maybe that's 22%, right? So I'm paying less taxes, and then the money's in there and it's growing, and it's not paying taxes as it goes because it's in a tax sheltered account. So that's the theory behind it. That's your typical just 401k. There's something called a Roth where let's say I make 100 grand, I put 3 grand into my Roth. I'm still paying taxes on the entire 100 grand. So I don't get any tax benefit today on that. But as long as I don't pull it out before I'm 59 and a half, when I finally do pull the money out, I'm not paying any taxes on any of it. So if I put in 3 grand a year for X number of years into my Roth, I'm paying taxes as I go. Let's say I put in I did it for 40 years, right? So 40 years times 3,000 is 120 grand. Let's say after 40 years, that grows to like $1.5 million. I'm not paying any taxes on any of that. And in fact, that 120 grand I pulled in, following certain rules, I can actually pull that back out and spend it as I go. So that's kind of a cool thing about a Roth. So the reason people would do a Roth instead of a 401k is if you expect to still be at a high tax bracket when you're older. That's one of the big reasons. And the second reason is, let's say you're putting it into a bunch of things and you think you're going to beat that normal, 8% that I'm going to use. It's going to grow faster. And so you really don't want to pay taxes on the back end the way you would in a 401k. So I'm going to share my screen. I'm going to show you a couple of things and some basic assumptions. But while we're doing that, do you guys have any questions? No? Okay. I had a cool comment from somebody that a traditional 401k, you tax the fruit, not the root. And in a Roth, you tax the root, not the fruit. Kind of cool. I probably won't use it because I'll get in trouble or somebody will misunderstand it. So I'm going to share my screen right now. And this is just, I don't know why this is over here. This is, let's say I don't use a retirement account at all, right? I'm 25 years old, and I'll change the math, but I'm just using the same example for everything. Let's say I'm 25 years old. I'm going to retire at 65. So my years of saving, it's 40 years of saving, right? Most of us are not in that boat, but I'm just using the math because the further out you go, the more exaggerated the result is. So I'm going to save $3,000 a year. In every scenario here, I'm assuming I take $3,000, okay? It's just normal money. I'm not doing a retirement account, so I'm not getting an employer match. So I set my employer match to 0%, which means my total employer match is zero, right? Over 40 years, I put in 120 grand, and let's assume I get 8% a year. So let's follow this math. In year one, I don't have anything there, right? It's 0, really. So I'm starting from scratch. I'm starting from zero. I put 3 grand in. But hey, remember, it's normal money. It's not tax shielded. So that $3,000, I have to put aside money to pay taxes on that, right? So I've got 3,000 out of my $100,000 income, but I'm not really investing 3,000 because I need 1,080 to pay the taxes. So I end up with $1,920 that I invest. It gets 8%, make 154 bucks. And at the end of the year, I have 2,074 bucks. So I started with 3,000. I paid taxes on that 3,000. I invested the 1920. I got 8% on that. And at the end of the year, I got 2074. So the next year, I'm going to keep doing it. I'm going to be consistent for 40 years, right? So the next year I don't start at 0. I start at the 2074. And I'm assuming you're putting it into like and some kind of exchange traded fund. You're not trading your stocks. If you trade your stocks, you lose taxes as you go. I'm just assuming there's no other taxes you pay except when you're in the money. So again, I take that 3 grand, I pay my 1,080 in taxes, I invest 1920, I made 319 bucks. So now I'm at $4,313. So let's follow this all the way for 40 years. In year 40, at the end of the 40th year, when I turn 65, I have $537,180, right? So I only invested 120 grand. I paid taxes on that 120 grand. So really what I invested, I'll tell you right now. So after taxes, wow, look at that. After taxes, I only put in 76,800. That $76,800 that I put in after taxes grew to $537,000, right? Now we're going to go into the retirement account. Like I'm 65, what am I going to do? Well, I started with that 537,000, right? I want, in all of these I solved for 75 grand. I want 75 grand in my pocket in retirement. So to do that at a 22% tax bracket in retirement, right? I'm pulling out $96,154. I pay 21,000 in taxes. I end up with 75 grand in my pocket to spend. But then whatever's left here is still getting 8%. So I grow by 8%. I make another 35 grand. I'm down to 476. If I keep that up, I basically get 7 years in retirement, right? I get 7 years of 75 grand a year in my pocket in retirement. So that's the example. I don't do any retirement accounts, but I am diligent about putting that 3 grand a year every year. Does anybody have any questions right now? Cool. All right, let's keep going. Now let's do a regular 401k.
John, I would just say it's confusing on your regular investment. It still says 401k. So I got confused for a second. A16.
A6. Oh yeah, sorry. You can tell I cut and pasted, guys. Good catch. Not a 401k, right? So it's go by this regular investment. Now I'm going to go to a 401k. You're going to love this one, guys. This one actually surprised the heck out of me. So everything's the same. My tax rate today is 36%. My tax rate at retirement is 22%. I'm 25 years old. I'm going to invest for 40 years and then retire. And I put 3 grand every year. But guess what? I work for a wonderful company who matches me 100% up to $3,000. So if I put in 3,000, they're matching it another 3,000, right? So over that same 40 years, I'm going to go back to the regular investment. There was no match. So I was only putting in $120,000, right? And after taxes, I was really only investing $76,000, $77,000. With employer match, I'm investing $240,000. It's $120,000 of my money and $120,000 of my boss's money. So I start out at 0. I invest 6%. There's no tax taken out of it because remember, that's the beauty of it. If I put 3,000 in, I'm not paying any taxes on that money in the year I make it. I'm going to pay it when I pull it out over here. We'll get to that in a minute. It grows by 480 bucks. So at the end of the first year in a 401k, because I'm able to invest that entire $3,000 and I get an employer match of another $3,000, I've got $6,480. That's at the end of the first year. Compare that with $2,000 in the other scenario. So it's 1/3. It's 30% if you do it without the 401k. Now, if you don't have an employer match, I'll just drop this to 0. You're still much higher. You're at 3,240 compared to 2,074. So this is for all the self-employed, right? You work for yourself, like 1099 brokers, that sort of thing. You can still do, it's still better off there by 50%. It's 50% more money. But I'm just going to follow this out again. Okay. So now you go all the way out to year 40, and guess what? Your amount has grown. You're putting aside $3,000 a year, right? You're not paying taxes on it. It's growing at 8%. Your company's matching it. You now have $1.7 million, a little less than 1.7 million bucks. Pretty cool. Now you're paying taxes at the end, just like you were in the other scenario. So you're paying taxes as you pull the money out, right? So in the regular investment, you're paying taxes as you pull the money out, and you make it a whole 7 years. You're off by 422, whatever. We're off by a couple of grand. I'm just going to call it 7 years. In the 401k, you pull out 96,000, you pay 21,000 in taxes, you have 75,000 in your pocket. The rest of the money is still growing at 8%. So at the end of my first year of retirement, I have more money than I started with. When I'm 65, I pull out $96,000, pay taxes on it, put 75 grand in my pocket. By the time I'm 66 years old, I actually have more money. It's still growing, right? And if I go 20 more years to 85 years old, not only am I still pulling out that 75 grand, my principal has grown to 3 million bucks. Now, one of the things I'm not doing here is factoring in inflation, but inflation is going to be equal in all scenarios. So just bear in mind that $75,000 in 40 years won't buy what it buys today, right? I know that that's a mistake in my formula, but we don't need to get crazy with this. Now let's look at the Roth. In the Roth, I'm at a tax rate today of 36%, tax rate at retirement at 22%. I put in 3 grand. My employer matches 100% for another 3 grand. I've put in $240,000 over the term. It's the same as the 401k tab, but it's not, because I'm taking taxes out as I go. In a Roth, you tax it in the year you put it in. Over here in retirement, when I'm 65, there is no red here. I'm not paying any taxes on the way out the door. So I put in 3 grand. My employer matched me for 3 grand. So I put in 6, but I got to pay taxes, 2,160. So I'm paying taxes on my money, and I'm also paying taxes on what my employer matched. So my net investment is 3,840 bucks. At the end of the year, of the first year, I've got 4,147. So that's double the amount without using anything, the Roth or the 401k, but it's only 2/3 the amount if I use the 401k, right? So there's the Roth. By the way, I'm having some fun with somebody that just keeps texting me because I can't talk to them. So please ignore the beeps. I will also try to ignore the beeps instead of blowing up mentally. All right. So in the Roth example, you end up after 40 years with a little shy of 1.1 million. You got $1,074,000. Remember, in the regular 401k, you're at 1.67, right? 1.7 million roughly. This really surprised me. I was very surprised that in this example, the 401k ended up with more money than the Roth. When would that change? Let me give you some examples. I'm assuming you're buying something and you're not selling it really for the 40 years, right? Which would really ding you over here, but it wouldn't impact you either in the Roth or the 401k. When the Roth gets better for you is if you change your assumptions on your tax rate at retirement. So let's say you're going to pay a lot more in taxes. You're going to be better off in a Roth, and you can find the break-even point for that. And the other place where a Roth would be better for you is if you think you're going to do better than that 8%. If you think you're going to do better than that 8%, it turns out your Roth is pretty cool. I didn't get into those scenarios because that's just a little more complicated than I wanted in this first call. If you guys want a more detailed follow-up call, give me some questions and I will set up a call with some tax experts. Even if it's only 3 of you that have detailed questions, I am super happy to set that up. But okay, going back to the Roth, I'm putting in $3,000 a year. My employer is matching me for another $3,000 a year. I'm paying taxes on it. So this is what I'm putting in every year. I do it dutifully for 40 years. I've got $1,074,000. And now if I'm not paying taxes on retirement, right? So if I want to withdraw 75,000 and put it in my pocket every year, I only have to pull out 75,000, right? In the 401k, if I want 75,000 in my pocket, I've got to pull out 96,000, pay 21,000 in taxes, and then I end up with the 75,000 bucks. So I'm not paying any taxes on the way out the door here. What's interesting is, again, I'm pulling out 75,000 a year, but my growth is still greater than 75,000. So at 65 years old, I start out with $1,074,000. I pull out 75 grand, and at the end of the year, I've got $1,079,000. I'm still making money in my Roth. And then 20 years later, I'm 85 years old. I'm pulling out 75 grand every year, and it has grown from $1,079,000 to 1.3 million. So I think that that's actually pretty cool, right? You're not paying taxes as you pull the money out. What personally surprised me is that in this set of assumptions, which, there's so many different assumptions you can make, it boggles the mind. But in this set of assumptions, after 40 years, I've invested 240,000. I've got 1.75 million, right? Which, by the way, is double if I did it the other way. So either a 401k or a Roth, mathematically better for you than just investing normal money. There's no way around it. And the other advantage is most people don't tend to be very disciplined about putting money aside for retirement every year unless they're actually in a retirement account. So you're going to end up with double the money at least. In this case, it's 3 times as much money. So that's a pretty good reason. And the other thing is, it's actually going to get you to put the money in every year. So very few people do that. So that's the basics, the basic math behind why you would want to use a retirement account instead of just putting money in every year into the stock market or whatever it is, wherever you want to invest on your own. There are some nuances if you're going to buy real estate or do some other stuff with your retirement account. You've got to follow 1 or 2 more steps, but you can do it. I do it. So that's my basic mathematical overview. And now I want to see if you guys might have any questions for me.
John, it's Ryan. I mean, I think one thing to think about, and that's how I've thought about the Roth too, is, people have different opinions. My opinion and opinion of many is that our tax structure is not going to stay the same for the next 20 years. So yeah, you're paying 36% now. So usually the mentality is, well, am I going to be making less when I'm pulling money out versus paying now? And I believe the taxes are going to be going up in the future. So it kind of rounds out that argument.
Well, let me show you how that impacts. I'm going to change tax rate at retirement for everybody from 22% to 40, right? So I'm going to go here. I'm going to go to the Roth. Yep, it all flows through. Okay, so you see how it changed? I tried to do it so everything would flow through if I made the change. So if your tax rate is 40% at retirement in a regular 401k, that 96,000 I'm pulling out doesn't give me 75,000 anymore. It only gives me 57,000. So let me play it a little bit with this and and find the number I've got to pull out to get the 75,000, right? I bet you this is it. Yeah, look at that. So now if the tax rate at retirement went up, I've got to pull out 125,000. Look at that. It's pretty close to the growth. So I'm actually going backwards a little bit, but very slowly, right? I'm paying 50 grand in taxes instead of 21,000. It's a big difference. If I go to the Roth, I'm not paying anything in taxes. right? So now I go 20 years, but still I'm just at the end of 20 years, I'm catching up to that 1.3 million. Remember in the 401k tab? It's still growing. It's still growing faster. So if I'm doing a 40% at retirement, it looks like a 401k in this set of assumptions is still a little bit better. And then if you go to a regular retirement, remember we had to change this to what, 125,000, right? I've got five years worth of money before I'm out of money. So I went from 5 to 7 years. So it's a lot better. It's still a lot better to either do a 401k or a Roth. Now, most of us don't have 40 years, guys, right? So there's a couple ways to do this. One of the ways is, let's say you've got 10 years or 15 or 20 years. You can save more, right? You can turbocharge that a little bit. If you're self-employed, I think, and over 50 years old, I think there's one way to do over 50,000 a year, assuming you have that money. Most people don't have that sitting around, but you certainly aren't limited to doing 3,000 a year. My kids work for me, like a lot of people's kids work for them. And so they already have their 401ks and their Roths. And I'm, in their case, I mean, and they can't retire for another 45 years. If they can retire in 45 years or 50 years, it's going to be pretty impactful. My hope is that I'm not working paying all their bills 50 years from now. That would be kind of nice, but at this point, there's no real reason to hope that. But you never know. But yeah, good point, Ryan. The tax rate matters a lot. And then, you start playing with these assumptions and an awful lot of things change. I will tell you, if you've got employer matching, it's free money. Look at the difference in this. You see this example where it grows to 1.7 million, right? With employer matching just on 3,000. If I drop this to 0%, I'm at 840,000. It doubles it, right? You go from 840,000 to 1.6, 1.7 million just by your employer matching you $3,000 a year over that period of time. Now, granted, it's going to be a shorter period of time, but my guess is your employer probably matches more than 3,000 a year.
John, many employers, instead of matching 100%, they'll match 50% up to 6% total. So, or up to the employee contribution of 6. So the employer gives 3. So that goes to 9 of your total income.
Yeah. So I'm going to share this again.
We give 4% to our staff.
Up to 4% of their income?
Yeah, up to 4% that they put in.
So if they put in $100, you're matching $4?
Let me go look. Hold on.
I don't think so. I bet you're matching up to 4% of their income.
So yeah, 4% of the income. But are you matching 1-to-1, or are you matching 50% of their contribution?
I'm trying to remember. I think the first 2% we match 1-to-1, and then I think it's 0.5% for 3 and 4.
Gotcha.
Okay, so what is it
and
now?
Like my advanced age, the most I can put in, the IRS limit is 31,000 per year.
So and how many years would you have?
Right now I have 4.
All right, so 4 left that you can retire?
No, 4 years that I put in.
Okay, but if you wanted to, let me do another, I'm going to do a Michelle example here. So now when I start playing with this, it won't ruin, my base spreadsheet, right? So let's say you can do 31,000 a year.
Yeah.
And the company will match how much?
4%. Up to 4%.
Up to 4% of your income. So let's assume that that's another 9,000. I'm just going to pick a number. Okay.
Not quite. So assuming that $31,000 is 4% of her gross income.
Yeah.
Once they're matching 1-to-1 for the first 2%, and then 1 to 2 for the second 2%. So she gets a 75% match up to the $31,000 for this example, that assuming 31,000 is 4% of her total income.
All right, so let me, this equals
But I
that.
doubt, I mean, that's a lot of salary income.
So let me do it this way. 75%, right? So now these two numbers go here. That's the 401k tab, right? And let's assume she's got 10 years till retirement. Michelle?
10 years for retirement. I would love that.
All right, let's do 15 years, guys. All right, but if somebody's interested in this, we can spend a couple of minutes and I can do a more detailed thing just for your situation. It's hard to do like a generic one, right? But let's do 15 years, right? And then I'm going to do this is,
The match is a little high, but that's okay. I'm not quite sure how to get it to where it needs to be. We'll just use it as is.
right. So I'm going to do, we're doing 50 years. So this should match. Yep. 1.59, 1.59. So in her scenario, she's putting in a heck of a lot more money, right? The company's matching 75%. It's making 8%. So if she puts in 31,000 a year and has, a 75% match, right? At the end of 15 years, you got 1.6 million. And again, in this example, even at the higher tax rate, because we're still using the 40%, she's got enough to go into retirement blissfully for a long time. Let's say she moves out of California, which a lot of people would consider smart in retirement, right? You're gonna end up with a lot more money in your pocket. Moving out of California in that example would put $20,000 a year more in your pocket while you're in retirement, and you'd still never run out of money, right? So, I use 3% just because I think that, I think a lot of people are living a little bit more hand to mouth than they should these days. And so, until the economy kind of recovers the way we want it to recover, I wanted to use numbers that weren't going to freak people out, right? So if I do it this way, I chose a $3,000 number because I think most people could do $250 a month. I think you could probably find a way to do that, right? If you go to Starbucks, you can definitely find a way to do that. You just stop going to Starbucks, right? That not going to Starbucks every day over a 40-year period in this scenario would put close to $1.7 million in your pocket. Think about it that way. Great comments, guys. Anybody else have any questions or something they want to kind of discuss?
One of the weighing factors for me why I put all my money into Roth has more to do with, or maybe not more to do, but I'm going to lose all of my major deductions by the time I retire. So I get a shield. Having 5 kids helps on the tax credit side, but the aspect of my income, even if it stays the same, I don't want to make less in retirement than I do today. And yeah. I don't think the way that our government is going, that they're going to be fiscally responsible and be able to balance or even not dig a hole faster than it's being dug today without raising taxes.
I tend to agree. The good news, guys, is if you're buying equities, if you're worried about inflation, if you're buying, a bundle of stocks, if I was going to buy stock, I would only buy it as an ETF. It's the cheapest way to do it. It doesn't kill you. It's got a little bit of everything. It follows the market. If you're worried about inflation, owning stocks and or real estate and or, things like gold and silver, which you can actually do, there's funds that follow those, it will adjust for inflation over time. So if you're worried about inflation, which you probably should be, this kind of methodical saving will protect you. It doesn't matter what the inflation rate is. Eventually, it sort of adjusts. And so, If it costs $2,000 to buy, $100 worth of goods today, then the things that you buy should also adjust up the same way. So you just want to, one of the reasons to do methodical saving is to protect yourself against inflation. If you got the money in the bank, you want to have some, but I look at leaving money in a bank account sort of like throwing it into a vat of acid. And the higher the inflation rate, the stronger the acid is. And the lower the inflation rate, it's just slowly eating my money, right? Because $100 today buys more than $100 in a year, no matter what.
Hey, John, do you know if there are different investment limits on Roths versus 401ks?
Yes, there are some differences, and it all depends on a couple things. It depends on your age, and it also depends on income levels. Because if you make too much, you actually can't put as much money into a Roth. There's backdoor ways of doing it. So there are limits. If you make a gajillion dollars, you can put money into a 401k. If you make a gajillion dollars, you can't really put money into a Roth directly. There are other ways of doing it. So it depends on age. It depends on specifically the type you're trying to do. Like, are you doing a solo 401k, or are you doing, if you're self-employed, you can do a 2-tiered, and you can do employer matching, and you're the employer, right? So it's more of your money that you're putting in there. So the devil's in the details on that. It depends on your specific situation. Does that help?
Yeah, it does.
Is there anybody here who hasn't done a retirement account yet and would like to have some help figuring out how to do it? Okay. If anything changes and you want some advice, let me know. We've got, you obviously can't go wrong with a Fidelity or something like that. Well, I'm sure you're fine with Morgan Stanley, any of these big groups. The biggest thing about retirement accounts is you got to get it done, number one. And number two, as a guy with a degree in finance, I will tell you, whatever you invest in, you want to have the fees be as low as humanly possible. So an actively traded mutual fund that has high fees will always over time perform less well than something that's got no active management fees. You would be shocked at that.
I have a quick question for you. What are your thoughts on the newer, almost self-managed, like Betterment or Wealthfront, those type of?
Is that like equity trust or a Madison, like self-directed?
No, it's more like
accounts?
they're the robo funds, robo advisors. It's more the ETF side where they're just low fee.
Oh, if it's that, then, and Andy, maybe you can speak to it some more, but basically if it's low fee, I'm all for it. But Andy,
I think it's like 0.5%. Yeah, I mean, because most of the time, whenever you set up a 401k, you talk to your advisor maybe once a year. This is kind of just takes that out of it, and yeah.
Anthony, once a year is once a year too often for me. It might be twice a year.
Andy, what are your thoughts on either one of those?
So I have an interesting situation.
I went to dinner with my wife and sister-in-law.
I have
a very loud pizza.
Thank you. I have a situation where I am a W-2 employee, so I have a company match or a company 401k, and that gives me a match, and that goes into a Fidelity, or it's nationwide now. So that piece is heavily taxed by fees. Right. And the only reason I still put money in there is, as John said, I'm getting a 1-to-1 match up to 6%. So that is free money that offsets the cost of those fees of having it, and then some. So it still is beneficial to me to put a portion of my money or max out the employer match for that contribution to that bucket of money. The rest of my money that I put into retirement accounts, I have an LLC that I set up a solo 401k for self-directed side of things, where I can participate in front or employee and employer contributions. And one of the interesting back doors that I learned in talking to my CPA is I can put more money into that or through that LLC than I actually make in that LLC. Because what happens is I can do up to 66,000 or 71,000 total between employer and employee match. But I don't have, and then you're limited by 100% of your wages. So you can't just funnel money through that. So what you have to do is make a contribution at a loss to your side hustle LLC, pay yourself both sides of the payroll taxes at 15%, and then you can funnel it into your 401k. And for me and my attitude to where the tax structures are going to be between now and retirement, I think it's worth paying that extra penalty to have control over that money and to have it in a Roth treatment. The last bit before I got into the 401k, the solo 401k, was just IRA contributions. And that's where I have both Wealthfront and Betterment accounts, but there's 10 or 20 grand or something like those that I just let it ride with different things. I think I got some Bitcoin ETFs through there. I think I've got some, that's E-Trade. I think it just has some of their target funds in the Wealthfronts and the Betterment side of things. So they're low fee, which I like, but I have been putting the majority of my money into the 401k side of things, the solo 401k, simply because I can have checkbook control over that and really tweak, as John's model shows, tweak that 8% up to 10%, 15% or higher, where that model definitely works in my favor to have the Roth.
By the way, I want to throw out one other benefit. I should have mentioned it before one or two people dropped off. Does the name O.J. Simpson ring a bell for anybody? So O.J. made the news and he won one case, but he lost the civil case. And when he lost the civil case, he lost everything he had, except he's still walking around doing well at golf courses, living pretty well. And the reason for that is that your retirement account by law is separate from you. So if you get sued,
he actually passed away.
OJ?
Yeah, he's dead.
Yeah, I know. Anyway, before he died. Yeah, before he died. I'm sure
He
he's
also couldn't touch his football pension. That was the big thing. He got 300,000 a year from football pension.
Right, that's what a retirement account is.
And they couldn't touch that. I know that.
Okay, so Rick just spoiled the ending, but retirement accounts, 401ks, Roths, pension funds, whatever, they're all covered by the same law. And that retirement account is immune. If you get sued, they can't touch your retirement account or pension. So by putting money aside, not only are you making your retirement a little bit more stable, you're also kind of judgment proofing a certain amount of your net worth every year as you go. So, those of us that spend time setting up trusts and irrevocable trusts and making sure we can't get sued and yada, 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 the reality is you can always get sued, but that pension fund or retirement account or 401k is just another layer of protection for you. So the reason O.J. Simpson, before he died, was walking around with some money in his pocket is, like Rick said, they can't touch your pension account. They can't touch your 401k. They can't touch your Roth. So that's pretty cool. And also your kids can inherit it, which is even cooler. So
do they get a step up basis on that?
You mean when they inherit it, do they get a step up in basis?
Yeah, or is it just taxed as part of your normal estate?
It's taxed. They inherit it as if they were you. So if it's a 401k, they're paying taxes on it as it's coming out. You can't really pass, like you could, if you own a property, you pass it to yourself, but you're paying ordinary income tax on it, right? That's a downside. But they can inherit your Roth, and they can pull the properties. Like if you have a property in the Roth, they can pull that entire property out tax-free. And I think you get that basis on the day you pull it out.
But you also cannot leave. You have to sunset that Roth, or all assets in that Roth, within 10 years.
There's specific rules for the different accounts.
They won't let that
It's-
ride off into the sunset.
I
And,
think it's 10 years after you hit the age, the minimum distribution age. So I'm
well,
52.
after death. So for Roth, they do not have a required minimum distribution. For
Yeah.
the traditional, they make you take the RMDs so that you're drawing that down over 10 years, if I recall, or something along those lines.
I think like I'm 52. If I pull money out of my Roth, I'm paying a 10% penalty. By the way, any retirement account that you pull money out, except for very small specific situations, if you pull money out before you're 59 and a half, you pay a 10% penalty and you pay ordinary income tax. So that's not so bad in the 401k because you're paying the normal tax anyway. You're just paying that 10% penalty. So let's say I earn my money in my 401k in California and I live in Nevada. Well, I'm not paying California, right? So I'm not paying that 13%. I'm paying 10% instead. Arguably, I'm better off pulling money out of my 401k early living in Nevada than if I'm in California. That's a side story. On your Roth, you're paying the 10% penalty and you're paying taxes, which if you just waited till 59 and a half, you don't have to do that. So I'm not 100% sure what happens. Let's say I was 40 years old, I died, my kids get my Roth. I don't think they have to take those distributions until 10 years after 59 and a half. I don't think they have to trigger a tax, but I could be wrong.
I have not thought through that or asked those questions. So good question.
Well, now you know why
Hopefully
I
I'll
don't
live
pay
to
much.
59 and a half.
Yeah.
Just don't die early.
Yeah.
That's
Well,
right.
in general, that's pretty good advice, guys. Don't die early. All right. Any other questions? Anthony, that was a great question. It sent us down a rabbit hole, but that was a great question. Thank you. Well, guys, 45 minutes in, I feel like we did a decent job going through the math. It was just a general overview. But the takeaway is whether you do a 401k or a Roth or any of these other kind of, or even if it's just a pension fund, if there's a way to match to it, right? I don't know if you can, but maybe if there's, the key takeaway is you're mathematically way better off, right? So I want to thank you guys all for taking the time to get in this call. If you have any specific questions, call me. If I don't know the answer, I will send you to the person that has the answer. I don't have any dog in this hunt other than I think you're all going to be better off in retirement if you do something, and I would like to see people not struggle in retirement. So with that, I'm going to do one last call for questions or comments. No? All right, everybody.
I would just say housekeeping clarification. The Roth treatment is separate from 401k. So you have a traditional 401k and you can have a Roth 401k. Michelle put that in the notes. So you can have, they're both a 401k. It's just, is it Roth treatment or traditional treatment? Just like you can have a traditional IRA or a Roth IRA.
Yeah, for simplification, I kept Roth separate. But yeah, you're right. As a technical matter, there are an awful lot of names for these things. So,
Yeah.
And as always, guys, I am not your priest, your lawyer, or your accountant. Always run this stuff by your own tax professional. If you do something and you don't get advice and it goes horribly wrong, you can't sue me or NAI Capital. With that said, right?
Now you say that. Man.
Yeah, I should have said that in the beginning. I've got to do like some sort of a flashy thing in the beginning. But listen, all kidding aside, I'm impressed that you guys took the time to listen to this, and I hope that if you haven't already put it into play, that you start putting it into play, and if you're in that position where you can actually start doing something for your kids, even if it's small, those spreadsheets showed you that time is a humongous factor in this thing. So the longer you're in a retirement account, the better off you are. And if you're blessed enough to be able to do that for your kids, mazel tov. All right, I'm going to stop recording this right now.